Hello and welcome to Views from the Market, Mid-Market Private Equity and M&A in Canada. My name is Mario Negro, and I'm a partner in the Private Equity and M&A group at Stikeman, Elliott. For today's podcast, I'd like to welcome our guest, Elliott. Elliott is the founder and partner of Strive Equity Partners, an independent sponsor based here in Canada. Elliott, welcome and thank you for joining us.
Thank you for having me.
Elliott, we always start our podcast by asking our guests to tell us a little bit about themselves and their history, and in your case, about Strive. If it's okay, we'll start there.
Yeah, sure. Absolutely. So in terms of my background, I started my career, and really the entire part has been mainly in finance. I'll back up a little bit. Grew up in Toronto, went to Schulich right here in Toronto. Spent most of my career in the US up until I started my independent sponsor firm. Started at Houlihan Lokey in their investment banking group, worked mainly within industrials and distribution businesses for businesses around the middle market, this $200 to $500 million enterprise value range. After that, moved over to private equity, worked in Chicago for a couple of firms. One was called Windpoint Partners, did mainly industrials as well as some consumer investing with them for a little over 3 years. Then after that, I joined a firm called New Harbor Capital. Took a little bit of an industry switch and started looking at a little bit more of tech-enabled services, looked at some healthcare and have done some deals in that space. And one other unique facet about New Harbor was that we looked at lower middle market businesses. So sizes closer to ones that I'm focused on now. After that, I moved back to Canada, back to Toronto specifically, and launched Strive Equity Partners. This was really, for me, the entrance into the independent sponsor space. Why I wanted to enter the space, mainly two reasons. One was the flexibility that it really offers on both from my perspective as an investor, as well as from my investors, the LPs, as they get to choose specific deals that they'd like to participate in. And then the second reason, which is probably the bigger reason, to me, it feels more entrepreneurial, where it allows me to have a bigger part in both selection of which deals I want to pursue and investment theses to chase, as well as working closer with the companies once you do acquire them. And that really comes through when you're working alongside the management team on a day-to-day basis. Not as a full-time operator, but in a very value-added, high-touch manner. That's sort of why I got into the space. I'll tell you 30 seconds about Strive specifically. We are focused on acquiring businesses in the lower middle market in the US and Canada in three sectors. They're industrials, healthcare, as well as tech-enabled services. And we buy businesses that are between 3 and 10 million of EBITDA and ones that are exclusively founder-owned. I like to partner with founders, and seller rollover is a key part of all my deals. That's sort of where my value-added aspect comes in, where I like to really help these founders drive their businesses to the next level. And even in the cases where the founders are looking to retire, I look to see if there's a second in command, or in sort of the last scenario, if we need to install a new leader. In either case, seller rollovers really help, and I like to get quite involved with these deals.
You decided to be an independent sponsor in Canada. Can I ask a little bit about your experience being an independent sponsor in Canada? How have you found the market in terms of being receptive to you and what you're trying to do? We're hearing more and more people like you are obviously interested in doing independent sponsor deals in Canada. This market seems to be opening up, but I want to hear from somebody on the ground in terms of their relationship with lenders, relationship with sellers, with deal advisors. Just do you find that the market has opened up to you?
I think the market's certainly a lot better than about a year and a half ago when I first entered the space. I would say it's certainly opening up. There's more capital partners here, family offices, some institutions that are taking note. The debt side from banks and lenders, they're certainly becoming a lot more comfortable with the space. And then lastly, the intermediaries, they're also becoming very receptive to the model. I know myself, as well as other peers, independent sponsor peers, are often part of these processes for sell-side M&A deals. So I think overall, it's becoming a lot more mature. Now, having some of the lens relative to the US, there's still probably a fair way to still go and progress, where some of the equity capital side is a bit more developed. It's a bit more supportive of the model. I think as we progress through the next few years and more deals are done in the space by independent sponsors, there should hopefully be some opening of the gates from institutional equity supporting independent sponsor deals from kind of the get-go rather than very, very late in the process. And I think that when that sort of begins to take shape, this model will become a pretty mature asset class, even in Canada and more specifically Toronto.
And if you tell us a little bit about the size of deals that you look for Strive, and in this marketplace, where is someone like you going to find deals, and what have you found in terms of sell-side advisors seeing you without committed capital? How much resistance are you getting when you tell them what you're looking for and you want to be involved in processes?
We have a pretty wide net. I look for deals between 3 and 10 million of EBITDA, and those are, I'd say, soft goalposts. Go a little bit lower, I can go a little bit larger. In terms of the most success, certainly you're going to find it on the lower end of the market. Even if you sort of start at 1 million of EBITDA, I'd say this 1 to 6 band is probably where you will find the most success, both from a deal sourcing perspective, because the funds that are the established funds in Toronto and some of the family offices will often tend to focus on deals 10 million EBITDA and up, but both from a sourcing perspective as well as from, hey, what can I do post acquisition? There's usually a lot of lower hanging fruit with some of these smaller deals and some obvious kind of value creation initiatives. So that's sort of the deal size. In terms of resistance, I would say, at least from what I've seen, not too much resistance. I think once you describe the deal history, where you're sort of coming from, what your acquisition parameters are and investment strategy is overall, and especially once you get in front of the sellers and just have a real conversation with them, that barrier is often broken. From what I've seen and what I've felt, it's been on par or similar with someone with a dedicated fund. I think the conversation pivots from funding to fit with that buyer a lot more. And that's really where I would say, at least from Strive's perspective, where we look for rollover, we look for that partnership model and have a bit more of an eye towards industry and growth and where we want to take that business. That's where those sort of factors begin to shine a bit more.
I mean, you've now completed a deal. You've completed Strive's first deal. I was wondering if you could tell us a little bit about the deal itself and the kind of challenges you had and the opportunities, I guess, in terms of getting that deal done, and I guess a bit of what you learned on the ground as you got this deal done.
Sure, yeah. We closed Centromax Centrifuges in February of this year. This was a pretty unique deal. Just a little bit about it. This is a repair, maintenance, refurbishment services provider for a very specialized piece of equipment called decanter centrifuges. It's a very niche industry with some good macro tailwinds, macro and micro. They service customers in water, wastewater, environmental services, energy, food and beverage, and so on. I would say some of the challenges with this deal, there was certainly some hair on a deal like this. And I would say generally for all of the deals that exist, at least most of the ones that I've seen, they'll have some kind of noise or hair that you just have to look through and get comfortable with. It's a matter of how you do that and what kind of diligence you do to get to the answer you're looking for. So similar in this case, on paper, there were certainly some things that stuck out, did the appropriate diligence and really understood why. And once you get those answers, me and as well as some of my equity partners and the debt and really all the stakeholders involved became a lot more comfortable with that deal. This one was a longer process for a variety of reasons, but glad we got it done. I'll double click into one more piece on how I diligence some risks. I like to box risks and assign a different probability to each. Some of them can be driven by an external or macro factor. And then it becomes a question of, all right, what's sort of the probability of that macro event happening? And then it might be a third thing that might be causing that. And then it becomes a game of conditional probability. And once you sort of bring it back to, all right, what does it mean for my deal and this company specifically? The actual risk might become a lot less probable than what it might seem at first. And we really weigh that against the upside of that, what that deal presents. And that's how I myself and others get comfortable with some of this. So just something to keep in mind.
And unless you have was this a a broker deal? Was it hard to raise funds? Did you have a hard time with finance? Just curious to your ability to kind of build the capital structure for this deal. Want to get your thoughts on your experience on the ground now, having done one.
Sure. This was a broker deal, came through a pretty well-known accounting firm. And from the capital side, the debt was supplied by a major bank in Canada. And they were sort of supportive of the deal from day one and really brought competitive terms to the table. On the equity side, it was a couple of larger parties, family office, as well as an institutional investor. In terms of kind of when I started to when that was wrapped up, I did go out to a fair number of parties, and this was the anchor investor year was interested from day one, and they were always in that lead position, and there was still some room to fill up. And it was always a dynamic calculation. And sort of by the end of it, I had a fortunate problem, which was a bit more capital than I really needed. And so worked through that as appropriate, and with just the goal of keeping everybody happy and the deal fair and getting it done.
Can I ask, you've now done your first deal. What would you say, the challenges, the opportunities, the things that you've learned from your first deal that you'll kind of say, hey, I'll be ready for the next one?
I'd say key challenges, or I'll sort of give a few things that I learned and maybe, things I want to remember for the next time. One is just patience. This was a longer term process. It took over 6 months. And I'd say just being patient and continuing to do work and making progress each week or each day. There were some lulls and pauses in the deal, which you'd have to work through. The other thing is communication with the sellers. There were certain points where the deal certainly, you always kind of, for someone in my seat, you always sort of have this probability of closing meter in your head. And there's 1,000 factors that can impact it. But I think solid communication is certainly something you want to strive to excel at to save the deal when it might be riskier, and just overall convey your seriousness and ability and interest in closing on time with the seller and the banker. We'll always want that process to be as short as possible. So it's important to sort of understand that. Other than that, my only other piece would be to be diligent with the entire due diligence process, lay it out at the start, knock it out piece by piece. Others will highlight risk. Ask everybody, for whoever you're communicating the deal to, for their input. If it's a simple pass, I think it's always important to ask why, not just for curiosity, but so you can also evaluate the deal for yourself and not miss anything, and really be as objective as possible in your evaluation of that deal from day one to the closing day. I think that's just your own fiduciary duty to yourself and to your investors. So leave it at that.
Can I ask you, Meet? I've been doing this for a couple of years. You're seeing the independent sponsor space evolve in real time. Where do you think this space is going to go from here? Now you've been looking for a deal, you've done a deal, you're looking for more deals. Where do you think this space goes from a Canadian perspective, given what you've seen and experienced?
Yeah, the short answer is it will certainly grow, is what I think. I think a couple of factors. One is just the growth of private equity as an asset class in general, where we have more firms, more people. That means a bigger pool of associates and vice presidents and principals and partners at these firms. And then secondly, I think within that, the unique benefits of this model, the independent sponsor model, will continue to push more and more of those folks into the space. The flexibility, kind of as I was alluding to earlier, is a key factor of that. It allows experienced deal makers to do deals in their own strategy and in their own way, and equity partners to support not a blind fund, but the ones who are looking to find an interesting deal, and that deal specifically, and structured in the way both sides like it. I think both of those factors are going to continue pushing the entire space forward, especially in Canada as well.
Neat. I want to thank you for joining us, telling us your story, telling us Strive's story and its success, and appreciate that you giving us your perspective on the independent sponsor space and kind of what it's meant to you.
Yeah, Mario, thank you for having me, and thanks for all your help with the process as well.
Thank you for tuning in to Views from the Market. Stay updated with the latest episodes by subscribing wherever you find your podcasts or visiting stikeman.com/viewsfromthemarket.